Yeah, why don't we start with Bitcoin? Because that's the craziest thing that's going on right now. We're seeing a God candle in the midst right now. No news as far as I know. I don't really know what triggered this move, but we are officially breaking out to new highs. How
Yeah,
far do you think this is going to go?
I saw some headlines that this possibly, the type of move that we had, the like we're talking about a $2,000 15-minute candle, right? Um, and even higher at the highs. This looks to be some sort of short squeeze underway. It doesn't mean that it is a weak move. It just means that, when you have things that are short squeeze, there's some fragility behind the move in terms of any pullbacks. Think of it like un or improper improper structure, or call it price management on the way up, right? Bids were just getting whacked out, price shot up, and on the way down, it could very easily kind of like fill that air and have some sort of consolidation in this zone. But all in all, I mean, we're very bullish on Bitcoin. I think that maybe we see a check back to 112, kind of testing the breakout, but all in all, I do think this goes higher, and 120 is just in arm's reach at this point. And I think given we're July 10th at this point as of recording this, where do you think we could see Bitcoin by December?
Really depends on risk on regime, how long the risk on regime lasts. But like, yeah, like we don't do price targets, but I would say we could probably get to 150 this year. I think that's a pretty reasonable amount. Obviously, there's a lot of factors that go into that, but we're just seeing risk appetite rising. Like this is a sign that risk appetite is rising. We're seeing the Russell rising, small caps. So I think this is turning more into a broader increase in risk appetite across the entire market, and that's exactly what we want to see.
Yeah, I agree with you there. I mean, look, it's not it's not bearish when Bitcoin's breaking all-time highs. That's just it's keep it that put it that way. It's not a bearish sight to see. So this is good. This is good news for the bulls, and I do think that this can easily continue as long as the trend holds, and we stay above mid vamp, which I've been pretty adamant on X about. As long as we're above mid vamp here, the base case is new highs. It's pretty simple.
Yeah, and we've got the Fed pretty much in a position where they're holding rates. Everything's doing fine at these current rates with what is it, two cuts priced in this year. So a very modest amount of cuts coming in, which is just gonna fuel it even more.
Yeah, two pretty much two cuts here, and we're looking like the cutting cycle may kick off with a 76% chance in September, which would be pretty interesting. And again, there's a big difference between what's going on in the markets in terms of policy expectation and what is being asked for by the administration. It does look like the Fed is certainly going to be enacting some sort of policy reduction. It's just the pace at which they're going to do it, or they're indicating they're going to do it, and what the administration wants is what is probably the largest gap right now, right? Like the administration wants, a year's worth of rate cuts in one meeting. Meanwhile, um, the Fed is trying to ease policy down on a wait and see approach where they don't run the risk of cutting too much too quickly and having to move policy back up again.
Yeah, like that there isn't really much of a reason for them to cut. I think they're pretty much right around the neutral rate. Like we're not seeing growth dying off, and that's really what you would see when they are above the neutral rate.
Yeah, and I mean we're also seeing we're seeing inflation swap spreads print consistently in negative territory. I think that a good indication here would be these swap spreads kind of taking out the post tariff day highs and really moving up towards zero, which post liberation day highs, excuse me, moving up towards zero to really give you the idea, or the market presenting the idea that tariff impacts are kind of behind it. It's not too worried, but there's still some sort of negative presence of tariff impacts here in the inflation swaps, which the Fed is probably going to look at this and say, as long as the front end is basically lifting or ahead of the back end, right? So what this negative spread is telling you is the 2-year swap is higher than the 10-year swap. And then even if you look at like 2 years you might say is a bit sensitive because tariffs are transitory. If you look on a 5 and 10, well, you'll notice here is the 5 year is also above the 10 by about 4 basis points. So it's a much tighter spread, but 5 years still over. And what you could see here last summer when the Fed was cutting aggressively, the 5 year was actually leading the way lower. So this is kind of the dynamic that we're looking at right now, where the tariff impacts and inflation uncertainties aren't really out of the market yet, but I do think that we could easily start seeing this rise, and that would be a good indication that maybe the Fed could add a little bit more juice to their cutting path. But all in all, I think that where the Fed is indicating they're going is somewhat already priced into the market. So this is what we're looking at: inflation swaps showing some sign of inflation stress, but not really the end of the world. I mean, if we go back to 2021, 2022 era, you'll see what I'm talking about right now with the swap spreads. Like, they were all the way down to like almost negative 200 basis points. We're sitting here at negative 30 basis points. So yeah, there's a bit of an inflation shock in the markets, but it's nothing of what we saw back when the Fed had to hike rates from pretty much 0 to 4% or 5%.
Yeah. What is the bearish news that you see right now, or something that could blindside the market? Because at the moment, I'm not seeing much. Like, there's the whole tariff debacle still going on, which I think the market just tends to ignore now. It doesn't really give a shit. It's just used
Yeah,
to
the
it
market.
now.
Yeah.
Uh, so what else? What can blindside equities?
Well, I think what you have to look at is that the tariff situation isn't behind us, but I would say it's kind of neutralized, right? So the idea that tariffs are coming or neutralized, we don't really know to what degree, right? Because obviously, like, you could just look at something like copper, right? Here's copper out of nowhere the other day, 50% copper tariffs. Obviously, copper price is going to go up, right? And if you go to the NASDAQ where we are right now, or let's look at the Qs, we're pretty much at or around all time highs. We're not exactly at all time highs today, but we're just under them. So if the administration wants to leverage some more tariffs in a way that's tactical, this would be the spot where they could do it. That would be the bearish case, because again, markets are at all-time highs now, basically, and the fear is kind of, the headlines in the media are no longer 401ks are down, right? So when everyone's crying about like the 401ks in the media, things like retirements are hitting new lows or whatever they want to, however they want to phrase it, it gets people very emotional, right? So when you're no longer in an environment like that, where basically the market's never been higher, you could also claim 401ks have never been higher, that even if you just take a dip, whatever it may be, for a tactical reason, if Trump really is on this tariff escapade, he can do that without necessarily recreating the entire panic from back in April. And I think that's probably the only real bear risk on the table, outside of the fact that we could see some sort of labor, black swan labor shock, but I don't think that's likely at the moment. I mean, unemployment rate just keeps ticking lower.
Yeah. And seems like rates have calmed down as well. So that's unlikely to cause problems anytime soon. So
Yeah,
it
well,
really looks like clear skies.
if you look at bonds, right? So here's the thing with bonds. Bonds failed now to break out to, and we'll take the unadjusted off, right? Bonds have really TLT has failed to take out the 85 level and hold it. So at this point, we had an attempt here in 23, attempt here in January of this year, another attempt post Liberation Day, basically, and then a final attempt in May, still failing. So if we can't break down from here, the logical case is at some point rates will bounce up. And I think that, you're in a position now where the deficit is obviously a major concern, but as long as growth is positive and labor is okay, rates kind of stay controlled as long as the Fed has its independence, right? Because the policy path is not significantly altered in the last year. The Fed's, maybe moving 1 to 2 cuts around the board. Meanwhile, interest rates have been up. TLT has been from 92 down to 82. So there's been a wide jaw here, a whipsawing from January to where we are now. And as long as the Fed doesn't really capitulate in the terms of like pancaking the front end of the yield curve, I think that bonds will hold some confidence that the Fed will be able to keep rates on some sort of proper path.
Yeah, and it's also dependent on the inflation's trajectory, and our system's not seeing any risk with inflation rising significantly either. So
Yeah, we had a blip there for a while, but it does seem to have like come back down to reality, and I think that's a good thing. I think at this point where we're going is one of two ways, right? Like we were saying earlier. There's the bearish case and there's the bullish case. Now the bearish case, you can argue it, you can look at it like this if you want to be more objective, right? So let's look at where we are. Right now on the NASDAQ dividend adjusted, we are up about 3%. We're up 3% from the February highs. So if you go back to February, it's now July. The market has only gone up 3%. So you can ask yourself, well, there's no recession. The deficit's still 6%. Inflation's under control. The Fed's not hiking rates. The Fed might be actually reducing rates, but caveat there, that's already priced in. So the idea that the Fed hasn't cut interest rates yet and the market's reacting on it, it's called forward guidance, right? So that's nonsense to say, oh, the Fed hasn't cut rates yet. When they cut, it's going to, fireworks. It's not how this works. It's already priced in. So the Fed has already kind of eased into the market. And then on top of that, labor's tight-ish, right? And you're not really seeing significant negative impacts to real GDP. So if that's what's on the table, the market's only up 3% since February. You had 1/4 of shakeouts at so far due to a surge in imports and inventories. What is really the reason why there's not to be a catch-up leg to be had here? Right? Like, slowdown is tapered off. What is the reason we cannot make up for lost time? Because if you look at it from a perspective of what we are up from the year, right? Like, go to real returns. Right now, I think the Nasdaq it says up to 9%, right? If inflation's 2, we have 7% real returns. It's okay. It's good. But I think that, that might be a really good return when you're running 2-3% deficit. But when you're running a 6% deficit, I think the real returns or nominal returns are higher as long as inflation isn't rampant, which we're seeing inflation controlled so far. So this kind of implies that a lot of the fiscal stimulus is kind of basically just baked into asset price. It's asset price inflation.
yeah, and even having just a small amount of inflation is going to help juice risk on assets as well.
Yeah, I mean, that's the whole point. Like when you have deflation, see, you can't really have um an economy that functions on deflation, at least in the way that we do credit today through credit growth, right? We need to basically borrow forward capital investments and stuff like that. And deflationary economy disincentivizes spending money into the future because it'll be worth less, right? Or it'll be worth more, sorry, in a deflationary economy, right? Like there's no point to make a capital investment if the investment is going to have an additional hurdle rate being the constant rise of the value of the currency being invested. So that's why deflationary economies don't necessarily work. And overall, the stock market has always been a good protection or good hedge against inflation.
Yeah,
And
well,
because
that's one of the reasons there's such thing as like a catch-up trade, like what you were mentioning. Like we have 6 months of not moving higher. Meanwhile, there's inflation eating away at currency that whole time. The market's going to have to catch up and price that back in. And I think that's exactly what we're seeing right now. That's part of the move, at least. That with growth as well on top of that.
yeah, I kind of agree with that to some degree, right? Like, look, the market's up 30% off the lows. That is scary. But that's not to say there can't be a small pullback in between now and the continuation of the trend. But if you scroll out even further, then just, don't be a bottom fisher and just look at the lows from where we are today. Look at where we, the average of where we've been versus where we are now, the market hasn't gone anywhere. Yet real GDP is basically unchanged from where we were last year, slightly lower, right? But not too bad. Jobs continue to print. Some softening in labor, yes, but like we're still printing above the maintainable threshold to keep the economy going. And on top of that, you have moderate inflation and the big beautiful bill. So these are all like very good for the economy in terms of the stock market, right? Now, is it good for the deficit? That's a completely different question. So I think that when we look at it, at the end of the day, whatever they want to do with the deficit, we don't have we can vote, right? We have the power in our vote, but we can't directly control it. So we have to take advantage of whatever opportunities present themselves. And the big beautiful bill should be asset price inflationary. It should be. Now, is it going to be harmful for the fiscal path of the government over the long term? Probably not going to be good, right? So if it's not good, it tends to be worse than it is good, and therefore it's a net negative. But at least for asset prices, it's going to be a net positive, and that's why I think that there's kind of like another, call it the IRA 2.0, except a bit more tapered. Thank you guys so much for listening. If you want to see how our models work in real time, have access to our interactive dashboard on our website, go to market-radar.com.